Hi everybody, this is Thomas Wynn, owner and portfolio manager for Wynn Capital Management. Today we're going to review the market action for the first quarter of 2014. This first slide is a quick look of the spiders over the past year. The spiders are the ETF that are the S&P 500, and it's a good way to measure how the general market, at least the U.S. large cap market, is performing. These little lines show the beginning of the first quarter and the end of the first quarter, and if you draw a line from the beginning to the end, it's almost flat. A very small gain for the quarter, but a lot of volatility. The market had a 6% correction in February, followed by a 9% rally, and the market ended with a very small gain. If we take a look at our performance for the quarter, it shows that all of our models were up slightly in the quarter. The benchmarks were up a little bit more. Fractional, we trailed our benchmarks by a fraction. This shows the allocation for each of the benchmarks, and basically we were trailing a little bit. Most of that is due to bonds, which the benchmark has long-term bonds which did better than our short duration bonds, which allowed us to have a little bit of a drag during the period. Just as a comparison, let's look back at the actually this is the same data, just in bar, and ours is the bluish performance, and we trailed, all of our models trailed by a fraction. If we take a look ahead, we can look back, of last year. This was the first year that we used DFA funds for our models, and every model outperformed its benchmark by 1% and sometimes about 3% for the moderate portfolios, 2% for moderately conservative, etc. down the line. But we do sometimes underperform, obviously, by quarter, but last year we had a really good year based on the full year, and we're hoping to do the same thing this year. I want to mention, in addition to performance, there is how much risk we're taking. We talked about this last quarter. We continue right now to be hedged. Almost the entire quarter we were hedged, and that, of course, puts a floor underneath the portfolio. The dotted line tries to depict the path of an unhedged portfolio. It goes up with the market and it goes down with the market. Our portfolios have this flat area that after it goes down a certain percent, somewhere between 5 and 10%, our portfolios stop losing money while the market continues to decline, and as other portfolios and unhedged portfolios and investors decline. Usually, there is a cost associated with hedging. In fact, we should expect, if the market rallies instead of declining like it did this quarter, we should expect that the cost of the hedge will hurt our performance. In fact, last year there was a little bit of a drag, but we overcame it through adding value in other areas. And in this period, we overcame our costs, and there was little to no drag from the hedge. We overcome that due to trading activities that generate money that offset the cost of the hedge, and we succeeded in doing that. It is a very unusual and valuable service to have limited amounts of risk, to have only a fraction of our capital at risk, a fraction of your capital at risk, and be able to capture all of the gains when the market rallies. So that has long been our aspiration, and last year to a great extent we accomplished it, and so far this quarter we've accomplished it as well. I'm going to go to the next slide and just jump into how the market summary that shows how the asset classes performed during the quarter. As usual, here's the 6 asset classes we take a quick look at: U.S. market, international, emerging, real estate, and bonds. And all up fractional except for emerging markets, which continue to suffer a little bit. This is the path of the market, and the news that was out there during the market shows that the market declined in January, February, rallied, and ended up just about flat. And as you know, you can pause this anytime you want if you want to read the facts and figures in any of these slides. Going forward, world asset classes in a little bit further subcategories. Most categories were up. Real estate was the big winner, and pretty small gains for most other asset classes, and a few emerging market categories were down in the period. If we look at large cap U.S. stocks, the large cap value subcategory was the one that was up the most, and all categories were up. And I'll let you take a look at this in detail if you want. You can pause and look at the 1, 3, and 5 years for this category. We'll go quickly to international developed stocks. Small cap was up the most in that category, with decent gains, fractional gains in the other categories. And then this area down here shows you what the longer term gains were for international developed stocks. Then emerging markets, as we've seen for many, many quarters. One small area, small cap emerging markets were up strongly, but all the other categories, all the other types of investments in the emerging markets were down. And so year to date, most are down. For the 1 year period, still negative returns and low returns, and all negative returns for 3 years. And of course, they did have a great run previous to the last 5 years. So the 5 year and 10 years show decent returns, which is why you own that category. This is the country performance. Developed markets, some of them up very, very big. Just a couple losers on the bottom. Emerging markets, a little more than half were up in the period. Again, very, very volatile. And some losers down at the bottom, including Russia, which is in the news. I'm sure most people are following that. Real estate was up big in the U.S. especially. And we own a little bit of real estate. About 2% of our portfolios are in real estate. And I'm going to go quickly to commodities. Coffee, strangely, up 58%. Commodities are wildly volatile and very dangerous to trade. We do have a small position in natural gas. We believe natural gas is going to go up in the coming years as it replaces other fossil fuels. And a few of the other commodities were down in the period. And this is just the editorial that DFA writes at the end of every review, market summary. And this is a little bit about Warren Buffett and a few of his words of wisdom. And that is about it. Short and sweet this quarter, as there wasn't too much to talk about. And I hope you find the material helpful. If you have any feedback on how we might make these presentations better, you can get in touch anytime. And also, if you know someone that might benefit from our services, please pass along our contact info. Thanks a lot, and call